Good afternoon, ladies and gentlemen, and welcome to 360 ONE WAM's Q2 FY24 earnings call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the management shares their thoughts. Should you require assistance during the conference, kindly signal the host by tapping on the raise hand icon. Please note, this conference is being recorded. On the call today, we have with us Mr. Karan Bhagat, Managing Director and CEO, Mr. Anshuman Maheshwari, Chief Operating Officer, and Mr. Sanjay Wadhwa, Chief Financial Officer. I now hand it over to Sanjay to take this conference ahead. Thank you.
Thank you, Anil, and a very good afternoon to everyone on the call. In the first half of this financial year, the domestic capital markets maintained its positive momentum and rose to all-time highs, despite global concerns related to geopolitics and inflation. Although there has been some correction at the start of Q3, we continue to remain bullish in the long run about the India growth story, with our business showing resiliency across phases. Before we deep dive into financials, we would like to highlight that we have announced an interim dividend of Rs 4 per share. This is our third interim dividend for this fiscal, taking the total dividend to Rs 12 per share. Coming to the business and financial numbers. In line with our focus on ARR assets, total ARR AUM increased to 203,000 crores, up 30.7% YOY. This growth was driven by strong net flows at 5,743 crores during the quarter. Our wealth ARR AUM stood at 1,38,243 crores, up 39% YOY, while AMC ARR AUM stood at 64,293 crores, up 15% year-on-year. As noted in all our previous calls, our focus remains to increase ARR assets and the resultant high-quality recurring revenues. Our recurring revenues increased by 9.6% YOY to 311 crores and up 8.3% YOY to 635 crores in H1 FY24, led by growth in assets across all business segments. During H1, recurring revenues comprised 76% of our overall operating revenues. Total revenues for Q2 FY24 are up 9% YOY and 1.6% QOQ at 441 crores and 13.1% YOY at 875 crores for H1 FY24. H1 retentions on ARR assets were 69 basis points, with wealth ARR retention at 65 basis points and asset management at 75 basis points. Excluding carry, ARR retentions have remained relatively stable at 61 basis points. For the quarter, operating cost rose by 2% quarter-on-quarter and 19.5% on a YOY basis at 214 crores. The employment cost increased 4.8% quarter-on-quarter on account of additional headcount, including certain senior level hires, which Anshuman will cover later during the call. Cost to income ratio stood at 48.6% as against 48.4% in Q1 FY24. Q2 FY24 PAT remains strong at 185 crores, up 7.3% YOY and 2.2% quarter-on-quarter, and at 367 crores for H1, an increase of 10.2%. Importantly, our tangible return on equity, which is ROE excluding goodwill and intangibles, was robust at 28.3% for the quarter. This is a result of prudent capital management and regular dividend payouts. With that, we come to the end of financial highlights. I'll now hand it over to Anshuman to cover key business and strategic highlights.
Thanks, Sanjay. Good afternoon, everyone. At the outset, as Sanjay shared, our overall financial performance and key business metrics remain strong. We are excited at reaching a milestone of 200,000 crores ARR AUM at the end of the last quarter, which translates to a 30+% growth over last year on the ARR AUM. Our overall AUM has also increased to $50 billion, highlighting the strength of our platform, relationships, and positioning in the Indian wealth and alternates asset space. While we focus on growth and continue to invest for the same, profit after tax, as Sanjay shared, show the healthy 10% growth over last year at 367 crores for the first half of this financial year, in line with our guidance for the full year FY24. Some key highlights on the business performance that I would like to call out. I think firstly, our core wealth business remains very strong, with ARR net flows of nearly 20,000 crores in the first half. And even within this 20,000 crores, about 75% coming from our discretionary and non-discretionary advisory proposition. Now, in this proposition, to bring greater clarity on the retentions, specifically for the non-discretionary advisory proposition, as a part of our enhanced disclosure this quarter, we have shared detailed information on our active ARR AUM. Apart from the treasury assets, active ARR AUM excludes assets of approximately 20,000 crores, which are non-fee bearing or low fee bearing. And this reflects the lag between flows coming in from new clients that are yet to be charged regular retentions, or flows from select old mandates which are continuing at low legacy retentions. A firm-wide strategic initiative is currently underway as a part of our practice management initiative to drive conversion of mandates to regular retentions, and we expect this to happen over the next 6 to 9 months. On the asset management side, while overall net flows have been muted, it is important to note that we have about 3,500 crores of planned distributions or redemptions in the quarter. Excluding the same, we saw strong flows across our listed equities and new PE funds, with some of our new PE funds going to continue getting and seeing inflows come in over the next few months as well. So we remain very confident on the outlook on asset management. The continued focus on deepening our channel presence in the domestic market, as well as the increased traction from global institutions across different strategies, has been quite positive. We understand that the present market cycles remains volatile, but our diversified strategies on alternates across listed, unlisted, credit, real estate, and infra allow us to see through these cycles with a far higher resilience than any other player. On our new businesses and some of the strategic initiatives that we've been speaking about over the last few quarters, I think the first half of the year has been actually very interesting for us. On the domestic front, we have been making continuous progress in sharpening our digital first HNI proposition. As noted in our previous call, this opens a new segment of approximately 160 to 170,000 households in the domestic market. We are excited by the prospect of being able to take our sharp and unique wealth proposition as well as the strengths of our current platform to this client segment. The business build out is progressing well, and we are on track for going to market towards the end of the financial year. We're also very happy to announce that industry veteran Satish Krishnamurthy has joined us to head this business. Satish has been instrumental in developing similar businesses from scratch in his earlier stints with large banks. On our current core wealth business, our focus on expanding beyond the tier 1 cities in the domestic markets continues. That will further strengthen the UHNI client base as well as continue to support the HNI strategic initiative as we build it out. Also, we see significant opportunities in serving the growing global Indian client segment and are in the process of expanding our platform and proposition for the same. Industry veteran Vikram Malhotra has joined us to build this growth engine and brings a wealth of experience, having built similar thriving businesses across diverse geographies, including Singapore, Dubai, London geographies, which are initially going to be core focus areas for us. Overall, we are very excited by the strong talent we are attracting across our existing and new businesses, but even more so with our existing seasoned team. It's a very proud thing to say that over 2/3 of our middle and senior leadership have a vintage exceeding 5 years, with overall attrition being in low single digits. We continue to be clearly a platform of choice for the best talent in the country in the wealth and alternates asset management space. So overall, we are excited by what we see in the first half. We recognize the challenge and the uncertainties as well, but we remain positive for the second half and we continue focus on the innovative, comprehensiveness, wealth and alternates focused product shelf, also venturing into new areas of growth. So with that, I'd like to open the session for question answers, and I'll invite Karan to take the same.
Yeah. Thank you, Anshuman, and thank you, Karan, for joining us. We now open the lines for Q&A. Kindly click on the raise hand icon to ask your question. We'll just give it a minute for the questions to queue up. First in line, we have Prayesh. Prayesh, kindly unmute yourself and ask your question.
Hey, hi everyone. Good set of numbers. But just Karan, there has been a sustained drop on your ARR realizations for the past few quarters. And, we have, earlier when it started, it was mentioned that there are some legacy assets which were given at a low realizations, and eventually it will trend higher with the mix shifting towards, newer assets. Then in the last couple of quarters, we've heard that, the flows have been lumpy, and the benefit of those flows will start flowing through over the next few quarters. But somehow this trend doesn't seem to be changing, and the retentions continue to drop. So how should we look about this in the future going ahead?
Thanks, Paresh. So no, I think you've kind of summarized it correct. The assets, in some senses, are broken up into two parts. One are so if you look at we've kind of given a breakup of the 62,000 crores. You have around about 32,000 crores which have kind of stabilized at the 28-30 basis points. I think there's a little bit of scope of that also improving. Maybe potentially that will move from 30 to 35 basis points, but otherwise the 32,000 crores is well settled. Now, on the remaining 30,000 crores, we have two breakups. We have 10,000 crores on the corporate treasury, which has always continued to be at 5 basis points, 4 basis points. So that's unlikely to change. Though that AUM pool by itself doesn't increase much. It's always in that region of 9 to 10,000 crores. It's really not focusing on corporate treasuries that much. The remaining 20,000 crores has nearly 10 to 12,000 crores of flows, which have come through over the last quarter or the last two odd quarters, maybe maximum 3 quarters. That essentially has a bit of a lag effect, and that takes around about 2 to 3 quarters to largely move into a normal fee mandate. Typically, our experience is 65 to 70% of that number moves into the fee mandate. 25-30% might not actually move in, but 65-70% of that would definitely move into the fee mandate with the same ratio of around about 35 basis points. So actually, the intent of showing the break is the stable state retentions around about 30 to 35 basis points. On the new flows, okay, there's a continuous lag impact. And whenever the flows are slightly larger in terms of percentage terms, nearly 4 to 5% of the, in this specific case, if you see the first quarter was nearly 11,000 crores, followed by 4,000-5,000 crores in this quarter. It is practically close to around about 10 to 15% of the existing AUM. And that has a largest impact on the retention. So our existing AUM on which we are charging fees was itself in the region of outside of the 16,000 crores was around about 46,000 crores. So it's effectively adding 16,000 or 46,000, of which let's say 10-12,000 is not yet fee bearing. So the immediate impact on the quarter looks large, but over the next 2 to 3 quarters it should normalize as these assets become fee bearing. Obviously, having said that, if there are a couple of quarters where the incremental AUM is not that large, okay, then automatically it will also stabilize. If the incremental net flows are very, very large, then again it can for 1-2 quarters show a 1-2 basis points dip because of the lag effect of the conversion of the new flows into chargeable assets. But I think we've had 2 largest quarters, so I think it's more or less there where it should be. I think the fees will automatically kind of move up without us actually increasing the yields because of the lag effect.
Okay, that helps. Secondly, if I look at your expenses also, and expenses have been on the elevated side and relatively higher than what we had earlier guided for. So how should we look at this for, say, this year and next year?
Yeah. I think that's right. I think expenses are around about 3-4% higher, but it's kind of, in some senses, so from a mindset perspective, I think the firm is looking at a little bit more of a growth bias over the next 3 to 4 years as compared to where we were potentially over the last 12 to 24 months. I think it's fair to say we were looking at the last 2 years as consolidation of our two key businesses and segments, which is wealth and alternate asset management. I think over the last 6 odd months, as we've dug deeper, we have much more confidence in our own brand and our ability to reach out to multiple new segments. And we've obviously invested in a whole set of people in building these 3 different segments. So, for example, on the high net worth space, as distinct from the ultra high net worth space, we've now got a team of nearly 35-40 individuals working very strongly over the last 3 to 6 months to prepare for our launch in April 24. On the global side, we've added a team of around about 6-7 individuals. Again, I think by the time we launch that business, it'll be between April to September 24. And thirdly, obviously on the geographical expansion, we've added a lot of, we've been able to recruit at least 10 to 15 extremely senior recruitments from different banks who joined us on the wealth management side. So I think outside of normal salary increases, I think we've had a fairly interesting expansion of individuals on the platform. We're fairly confident all of these 3 different sets of individuals will deliver the right results over the next 6 to 18 months. And therefore, we feel this 3 to 4% increase in cost to income in some senses is a temporary dislocation. On the core business itself, we've honestly not seen any increase. It continues to be in the region of the 44, 45. I think we've added 3.5% for these 3 or 4 new growth initiatives, which we believe will play out very well in the next 12 to 24 months.
So, Karan, on these 3 new business initiatives, the global, so would you be running them as separate business units altogether, and we could expect some reporting also coming in differently for these?
For sure, we'll do that. Except for, I should just the geographical expansion piece obviously will happen much faster. Because that's the product, the platform, everything set is just about getting the right set of people in different locations. So that pretty much happens here and now in the sense over the next 2 to 3 months. I think the high net worth business and the global business, I would say, we would be in a position to start reporting separately from April, which is essentially first quarter of next financial year. And I think the global business maybe potentially a quarter after that, because by the time we really go to market for both, I think the high net worth business would be around April 24. The global business potentially July 24, worst case September 24.
Just last question from my side. If you have to say, look at next, say 3 years time frame, how would you see the share of the current business, the HNI business and the global business in terms of AUM, revenue and profitability?
So this is specific. Okay, so I'm going to exclude the asset management side and try and answer the question. I think if I was to see the existing business, so obviously the existing business also is going to grow substantially, right? So I think we'll have to balance it with that. But purely in percentage terms, I think the 2 new businesses, which is broadly the global business and the geographical expansions, I think on an incremental basis within the next 3 to 4 years should allow us to add around about 20 to 30% of what we've already built. Not in the sense of today's numbers, but on the expanded base, because the existing wealth business itself will also expand quite a bit over the next 3 to 4 years. So I think of that, around about 20 to 30% should get added.
From both these
engines, yes.
Both these engines. Yeah. Great, thanks. I'll come back.
Thank you, Brett. Next in line, we have Mohit Mangal. Mohit, kindly unmute yourself and ask your question.
Right. Thanks and congratulations on achieving 2 trillion of ARR AUM. My first question is on profitability. So if I look at first half, we are around 367 crores, while we have given a guidance of around 800 crore for the entire year. So do you think that, that would be achievable by going by current numbers?
So Mohit, I think honestly, we feel comfortable with that guidance of 800. However, I think we will end up incurring around about 30-40 crores of cost extra for the reasons I just explained. So I think, but obviously 30-40 crores from a revenue perspective is not a large number, and we would work hard to ensure that we can cover that through a little bit of transaction and brokerage revenue. So all things being equal, we should still aim for that 790-800 crores number. Just to kind of give the context right, we'll have to get to the 800 crores number with an incremental cost of 30 to 40 crores.
Perfect. I was looking at your net flows. I think if I look at AMC, both private equity and long short have been giving outflows over the last 2 quarters. This quarter, the number looks little amplified as well. So what could be the reasons for that, and how do you see that going forward?
Long short is episodic. We've kind of decided not to continue with that business. So it's a one-time 1700 crores outflow. Private equity by itself we started the fundraise. So it's broadly going to culminate around February, March. I think we would expect most of the private equity outflows we've seen through this quarter as well as in the last 2 quarters to all come back in Q4. So we don't see that as a permanent outflow at all. I think we would be surprised if we don't end up getting higher than what we've seen as outflow in Q4.
Okay. Other thing is that if I look at your transactional revenue, it has grown by around 40% sequentially. So any major deals that we have done this quarter, syndication or something?
Nothing major, honestly. I think it's pretty much part of the normal thing. I think we would have had 10-15 crores extra income from a little bit of NSC syndication, but outside of that, nothing really to be amplified or talked about.
All right. Thanks and wish you all the best.
Thank you. Thank you, Mohan.
Thank you. Next in line, we have Gaurav Jain. Gaurav, kindly unmute yourself and ask your question.
Yeah, hi Karan. Thank you for the opportunity. In the last Concall, you highlighted that the secondary liquidity events were that was on the higher side, and we got a major chunk at 65-70% of those money.
Yeah.
So just wanted your perspective on how has this quarter been on that regard?
It's similar, honestly. I think if you just gross up our flows and redemptions of 3,500 crores on the private equity and the long short, I think we still ended up getting a very healthy portion of the secondary transactions in the wealth management side. We still would be between the 60 to 70% number. So very happy with that market share participation. As we speak, even in this quarter, there are already 3 or 4 large transactions, and we are pretty much part of all of them. Yeah. So overall feel comfortable with our ability to be able to access clients with new liquidity events.
Great. Second question is on the balance sheet. What is the reason of this borrowings excluding debt securities going up to some 1980 odd crores as on September 23, which was just 200 crores as on March 23, and this has also led to finance cost going up, and correspondingly what has gone up is the investment line item. And if you can also help us understand why is this other income not adding up to the investments that we carry. I mean, other income for half year has been only 42 crore versus on a 4,500 crore investment that we have. So why has the borrowing line item gone up, and why does other income not match to the investments? While I understand the investments is in AIF, etc. But
so part of the investments are in is basically in Government of India bonds. So we have a structured note essentially through which clients get participation to the GSEC. It allows us to borrow substantially cheaper. For that portion of borrowing, we effectively end up borrowing at sub 8% rates. So effectively the balance sheet on the investment side gets bloated a bit because of investments on the into GSECs through the CBLO market. But that's really what happens. That's approximately around about 1,500 odd crores. On the investment book itself, we've broadly got a liquid net worth of around about 2,450 crores, of which around about 1,500 crores is in the NBFC. Around about 950 crores is the liquid net worth outside of that. We've got a working capital of approximately, give or take, 25% of our revenue, so approximately 350-400 crores, which leaves us with around about 500-550 crores, of which we've got 75-100 crores in our fixed deposits for the brokerage account. So we've got around about 400-450 crores of net cash surplus. Against the 400-450 crores net cash surplus, we've got the investment book. So really the investment book in some senses gets offset for the borrowing cost. So it adds a relatively lower portion to the other income. So really the way to look at other income would be on a 500 crore investment book. I don't know if that makes sense. 500 crore investment book plus 100 crores of FD. Yeah.
Okay, and anything around this borrowings going up, or all of this is just to...
So borrowings is effectively against the G-Secs, right? That's borrowing is against the G-Secs and the loans. Our loan book has gone up by 300-400 crores, and the borrowing is effectively in the same road. There's no real increase in borrowing as such. Sanjay, do you want to come in if I'm missing something?
Yeah. So you covered it well. So GSEC and CPLO both are bloating the balance sheet. So one is on the investment side and one is on the borrowing side.
Yeah.
Okay. Thank you.
Thank you. Next.
So there's an increase in GSEC of exactly 1,100 crores against the CBLO borrowing exactly of the same amount.
Yeah.
Thank you. Next in line, we have Abhijit. Abhijit, kindly unmute yourself and ask your question.
Hey, hi everyone.
Hi.
The first question is that looking at the results for the past few quarters, you get a sense that the franchise is getting stronger, but there is some sort of, normalization because of, past money which is going out. So you've given some sense on the wealth side, but is there a flow pipeline on the AMC side given the planned fundraisings?
Yeah, no, that's a fair question. I think on the private equity side, we had a scheme for special opportunities, which was a fairly large scheme. It was at cost close to around about 8,000 crores, and on realization nearly around about 15 to 18,000 crores. The 15 to 18,000 crores is obviously kind of being paid out over the last 2.5 years. But the residual part of the scheme, which is around about 6,500 crores of the 18,000 crores, gets redeemed through the year as we speak. So out of the 6,500 crores, you've broadly seen a redemption of 1,000 crores earlier in the year, and another 1,500-1,600 crores now. So you've seen 2.5 of the 6,500 crores get redeemed. But our new funds kind of got launched now. I think most of the 6,500 crores will come back, but the scheme will only end in Q4. So of the 2,500 crores which has gone back, plus another 4,000 crores which will go back over the next 14 to 15 months, we expect the same amount to come back into the new schemes, given the decent performance of the old schemes, and initial indications of the launches are also fairly positive. So I think the private equity outflows which you're seeing in the last quarter and this quarter will get more than complemented by the new scheme at the end of the financial year. Not in Q3, but in Q4. The schemes are already launched. They will close by Q4, February, thereabouts.
So one clarification, Karan, here is that given that the relationships that we have with these clients, people who invested in these funds, that remains alive, but the funds have got redeemed. So do you really, need the clients to, reallocate those amount of funds, or the redemption is sitting somewhere in your books itself that gets redeployed?
It would be a combination. I think 55 to 60% would be still sitting on our books. So there are obviously two parts, right? There are funds which are distributed by our own distribution business on the wealth management side, and other funds which are distributed by external distributors. So if I remember correctly, I might be off by a few percentage points, but if I remember correctly, of the 7,500 crores of special opportunities, I think round about 75% was by our own distribution unit and around about 25% by other distributors. So of the distributions, 25% to the other distributors obviously goes back to the clients and needs to get reallocated. Of the 75% which has gone to our wealth clients, 65-70% would be sitting within the system itself.
Got it. Karan, second question is that on the mid-market piece, so we don't have good market comparables, but going by the recent disclosures by another firm, this business tends to operate at maybe 60-70% sort of cost to income. Is that a fair number to look at? And what would be your, let's say, guidance or let's say target where you would like to operate this?
A couple of years, 60 to 70 may be fair, but eventually I think 45-ish is where it should end up. 60-70 is too large.
That's only in the initial phase, you're saying?
Yes.
So even the mid-market can operate at the current wealth business.
Yeah, so we are only going to add distribution costs, right? Everything else for us is already there. Whether it's the product, technology, in that sense, every other part of the business outside of distribution, we've already kind of get covered. We don't really need to build out absolutely full-fledged teams for product, for advice, for analytics, for compliance, regulatory. It's absolutely, in that sense, it's a new segment for us. It's not a new business, if that makes sense.
Understood. Just a last final one. How do we look at the, impact of, mark to market on the unlisted side? Because unlisted side of the investment book, both on the investments as well as the balance sheet, because I think that's not as correlated to what we are seeing in the public market. So fairly difficult to, project.
On a last 4 or 5 year basis, I think it'll be close to around about 13 to 16% on the unlisted side. So it'll be relatively higher than what we've seen on the listed piece. But you're right. On a quarter-on-quarter basis, it's not that easy to kind of correlate it with the index itself. But for all our unlisted investments, I think broadly returns been in the region of maybe 13 to 17%. So in that sense, it's paid off well. But quarter-on-quarter, there can be a bit of an aberration compared to the listed markets.
Got it. Thanks a lot.
May I remind you to ask your questions, kindly click on the raise hand icon. Next in line, we have Dipanjan. Dipanjan, kindly unmute yourself and ask your question.
Am I audible? Hello.
Yes. Yeah, hi, Dipanjan. Hi.
Okay. So then just a few questions. First, over the last few quarters, you have mentioned that there is a pipeline of institutional mandates that might come in. So just wanted to get some idea of the traction on that part for the quarter or maybe for the next 9 to 12 months. Second, on the cost front again, I mean, what proportion of the cost do you think has already been absorbed or upfronted? And what can be the recurring cost that can come in this sort of a business going incrementally? You mentioned that 60-70% for the initial few years might be a legit guesstimate, but just wanted to get some sense of how do you think, of the cost that has been absorbed and the new cost that might still be incurred in rolling out the team or the tech capabilities, etc. And lastly, in terms of your flows on the ARR business, if you can you mentioned that the current quarter is also seeing strong traction. So do you kind of expect to increase your guidance on that, both from, let's say, 2H and FY25 going out there?
No, so I think I'll maybe start with the last question first and then I'll come back to the first two. I think from a net flows guidance, I think we've given a guidance of somewhere between the 35 to 40,000 crore number. I think that's a fair number. I think that's really where we'll end up for the current year. FY25 might be higher, but it's early days. But I feel confident about a stronger FY25 on net flows. But for the current financial year, I think that 40,000 crore number is broadly in the right ballpark. In terms of expenses itself, I think both from a technology spend as well as a distribution spend perspective, I think we've kind of reached a little bit of a stable cost. I think we will be adding a little bit more on the distribution side of the business for sure. But obviously revenues will also start kind of coming in. I personally feel we have a lot of operating leverage in the business, just given our own experience over the last 10-15 years, as well as all the other parts of the business which are well set up. 60 to 70% is obviously a function of how quickly we are able to scale up. But I would like to believe year 3 onwards we should be below 50%. But obviously still early days. We've not yet gone to market yet. So we are in some senses right now more in expense bearing mode for the next 6 months as opposed to revenue booking mode. But I'm fairly confident from April onwards, it'll be net, in some senses, it'll be net positive. And we'll see some kind of fruits coming up for our extra 3 to 4% expenses. On the third question, I think I would like to believe, I think the 3 to 4% is also kind of a temporary dislocation. I think we have some efficiencies in our core business, which over a period of time we will be able to reduce our costs by 2 to 3%. And eventually, I think over a period of maybe 12 to 18 months, including the new incremental cost, we'll be able to get the cost to income ratio down to 45. Because as we've kind of obviously recruited a huge number of people over the last 3 to 6 months, there are certain efficiencies which can be derived in the existing teams and setup itself. And honestly, to adjust that in a quarter or two is difficult, but we see a clear roadmap to be able to get our core business of the ultra high net worth and the alternates down from 45 to maybe 42, 43, and then kind of absorb this extra 3-4% on top of that itself.
Got it. On the institutional mandates?
Yeah, sorry, I forgot that. So on the institutional mandates going well, honestly, I think we have 3-4 large mandates, of which one mandate's kind of partially already converted this quarter. So I would expect at least a couple of mandates to go through between now to end of March.
Got it. And if I can squeeze in one more question, your TBR revenues have obviously been quite high, obviously to some extent linked to the current market conditions. Any guidance or any sort of visibility that you have for the second half going on?
To be honest, I think TBR revenue, we're very comfortable between that 350 to 450 crore number. That's the ballpark number we are comfortable with for the year. Obviously, if markets are super tepid, it can move towards the 350 number. If the markets are stable to positive, it can move towards the 450 number. So that's the broad number we are comfortable with. I think the current year, given the fact that the first 6 months are over, and even for the current quarter, we've already been through the first 30-45 days. I think being closer to that 400 number, 400 plus number, seems a fairly comfortable number for the financial year.
Got it. Thank you, Karan, and all the best.
Thank you.
May I remind you to ask your questions, please click on the raise hand icon. Mohit, you've raised your hand again. You have a follow-up question?
Yeah. So just one thing. So one, I think, so a couple of questions. So one, I think we acquired Mumbai Angels around 7 to 8 months back, and just wanted to know how that is progressing.
It's progressing well. Our app is just about got prepared. I think we launch it maybe end of this month or next month. And post that, we start our distribution efforts there. We're working with the existing team as well as incubating new people. So I think around December, Jan is really when the new version of Mumbai Angels will get launched for us.
All right. Just to follow up on a previous participant's question on other income. So you said that, around 42 crore on a 500 crore investment would be the right thing to look. But I believe other income is more of an M2M gains and losses on our investments in AIFs. So I think, do we have some M2M losses there?
No, Mohit, it has to be netted off the interest cost, right? So broadly, what I'm trying to say is round about, let's take 500 crores. Let's assume if you're having 60 crores, or let's say 500 to 600 crores. I might be off by 50-100 crores. 500, 600 crores is a net investment after working capital. On that 600 crores, broadly, if you're earning 60 crores, it's, and we are investment in our own AIFs is around about 1,500 crores. So the remaining 800-900 crores also has to be netted off the interest cost. So the other income, 60 crores is basically the net income post the interest cost.
All right. Yeah. Thanks for the clarification.
Yeah.
That's it from my side. Yeah.
Yeah. So, okay. Just to explain again, the interest cost relevant to the investment book is netted off the other income, not part of the NIM. NIM is only the interest cost relevant to NIM. Yeah.
Okay.
Yeah. Thank you, Mohit. Next in line, we have Aejas Lakhani. Aejas, kindly unmute yourself and ask your question.
Yeah. Hi, Karan. Thanks. So, Karan, just two questions. Could you speak about how the competitive landscape is shaping up? And point number two, could you give some granular color about the mid-market and, how is the scale up, going to happen? What are you going to chase first? Is it going to be asset gathering from day one, or is it does the scale require you to sort of develop relations and asset gathering is a more granular process in the mid-market? So some color on this. Thanks.
Yeah. Sorry, what was the first question?
On the competitive landscape.
The competitive landscape, yeah. So I think on the competitive landscape, honestly, I think stays the same largely. There are 4 or 5 different pools of competition. Obviously, you have the banks, largely you're kind of some of the banks which have a ultra high net worth stroke of wealth kind of offering. There, I think not too much of change, honestly, over the last 12, 18, 24 months. Most of it continues to remain the way it was. I think second largely is some bit of boutique players. So you've got 3 or 4 boutique players who've kind of are kind of relatively aggressive and positively kind of wanting to build a business in the space. There we continue to see, it's fair to say outside of us and one bank, one of these 4 or 5 players in every mandate. We really don't have a trend yet to say that it's a similar player across every client, but it seems as if there's one player across every 4 or 5 mandates. Third, obviously, you've got brokerage firms who've already got a good client base trying to kind of upscale to wealth management. And fourthly, you've got a little bit of independent financial advisors and some new boutique setups, which are kind of wanting to set up more as external asset managers. So we'll have to, all of these are in different stages. From our own competitive positioning perspective, along with one of the bank competitors, we continue to believe that between the 2 of us, we have a large market share. Really haven't seen a big change there. We'll have to wait and see how the global names kind of play out in the country. As of now, really very little traction there. But we'll have to wait and see whether they want to make a renewed push into the country, into the business. So right now, I feel fairly relatively sanguine about the competitive landscape. Having said that, obviously, we need to keep our eyes and ears open. But there's no drastic change in the competitive landscape over the last 3 to 6 months. On the does that answer your question?
Yes.
Yeah. On the second question around the granular color on high net worth, I think you're absolutely right. I think the asset gathering exercise has to be substantially more granular, and it has to be slightly more segment driven, okay, as opposed to looking at specific ultra high net worth families and only going after a certain circle of influence. The good news, however, is most every ultra high net worth family of ours would himself or herself be a large circle of influence for a large pool of clients within the high net worth space itself. So if you just look at our existing 5,000 to 6,000 families, they themselves, from a connection perspective, give us access to at least another 40,000-50,000 families. And obviously, our own coverage through our own other businesses gives us access to another potential 100, 200 connections, therefore leading to another 3,000-4,000 families. So I think the initial build out in year 1 would see us kind of going out with a lot of our already built connections over the last 12 to 15 years, both from a Salesforce perspective as well as from a client perspective. Having said that, you're fully right. The product proposition as well as the asset gathering has to be substantially more granular. But in terms of our ability to reach out and our ability to actually access the final client, it's not an absolute shot in the cold exercise. We have a very good feel as well as the reach on where exactly we want to head towards.
Oh, got it. Thanks. That's helpful.
Great. Thank you. Next in line, we have Bhuvnesh. Bhuvnesh, kindly unmute yourself and ask your question.
So thank you for the opportunity, sir. So just a question on the business model. So one of our competitor was talking about they are having a model of external RMs, where the RMs are not on their payroll. I mean, it is purely on variable basis. So, and they were saying that it is quite workable in international markets as well. So just want to understand your thoughts on that. Are we looking at that model?
No, so I think personally, I've kind of studied that model multiple times over the last 10, 15 years. And my personal view, at least, is it's too early for us to have external asset managers. I think the market's extremely large. By kind of, in a sense, handing over control of the client to an external asset manager so early in the life cycle, I think it's a bit of a challenge. I think you're losing the lifetime value of the client. I think we have a unique combination of having the right set of relationship managers and a very strong platform for us to be able to reach out to potentially every ultra high net worth family in the country. So I think for us, we really wouldn't like to believe that we need to take a shortcut to use an external asset manager to reach the client. Because once you do that, in some senses, you kind of give up control of the client and therefore give up lifetime value of the client. And given this capability and the brand we built on the platform, honestly, our ability to access every client either as a service through our advisory platform, or sometimes the client's already tied up on a service-based model with somebody else, get the right inroads through a product and finally convert it to service, is both there. So honestly, I think given the size of the market and the deep inroads you're going to see over the next decade, we wouldn't really want to get into the external relationship model right away. At some point, we believe that model will come through, but I feel we are nearly a decade away from us from the market being that deep that we need to kind of go into that model.
Got it. And sir, if I look at our discretionary PMS in under 361 plus, so that AUM has kind of declined sequentially, hasn't grown, I mean, much in last couple of quarters. So
Yeah.
So how do you see that, and why?
No, I think that strategy had a couple of large redemptions, but it's done extremely well. It needed a little bit of rejig. We're very positive on it next year. I think it will add a huge amount of momentum over the next 3 to 4 quarters. It's come up quite well. It's going to be an integral part of our strategy.
Right. And you, I think in press release, you mentioned that you are strengthening that advisory proposition. So particular steps you can outline.
I think it's really a large learning exercise, right? Because it's in some senses 9 quarters old, so it sounds old, but in reality it's 2.5 years old. So we've also gone through our own learnings. But I personally feel what we built on the advisory and the discretionary PMS side, as well as on the RIA platform, really nobody in the country has built out, and that distinctive edge is available for the client to see as and when we go out and meet our clients. And it's kind of shown to a certain extent in the 35,000 crores of fee-bearing assets we have. Given where we are in the platform, it's not impossible to believe that number. The first 1/3 can take some time to come, but for the first 1/3 to become one whole, may not take that long, because once the 35,000 crores is established, the operating leverage on that platform becomes very large. Because unlike the wealth distribution business, that piece has huge amount of operating leverage, pretty much like any other asset management business. So I'm quite confident the ability to scale that 35,000 crores quickly will be substantially larger as compared to a wealth management distribution model.
Got it. And sir, in terms of yield, I couldn't understand clearly what was the steady state yield you mentioned on this.
Non-discretionary advisory side around about 30 to 35 basis points. Discretionary side around about 50 to 55. I know the numbers are 5 basis points lower than what I'm saying, but I think it'll stabilize at the 30 to 35 basis points on the non-discretionary, and 45 to 50 basis points or 55 basis points on the discretionary.
55 basis points on discretion. Okay.
50 to 55, yeah.
Okay. Yeah. Got it, sir. Thank you. That's it from my side. Thank you.
Thank you. We have one last follow-up question from Prayesh Jain. Prayesh? Kindly unmute yourself.
Yeah, hi. Thanks for this.
Okay.
So, just a very broad question, Karan. There has been a lot of trend changing in the way people are investing today, and we've seen a lot of global investing happening, global citizenships that people are talking about. So how much are and especially we've heard about this in the ultra HNI families, and they want dual citizenships in the geographies like Portugal and these geographies. So how much are we playing a role out there, and anything that can be meaningful here?
Honestly, we don't play a role in facilitation of individuals kind of relocating or something like that. That's really not something which we play a role in. But if people do have one family member becoming an NRI, in that sense they are able to remit a little bit more money because current income comes without the cap of $1 million which is available for an NRI. So dividends, rent and interest in that sense can be additionally moved out over and above the capital amount of $1 million available for NRIs. I think that's really where we've seen pretty much maybe in the super ultra high net worth space, a few families have one family member move out maybe to Dubai, Singapore, London, and so on and so forth. In which case, obviously, even then, 90 to 95% of their assets have to remain in India because you really can't move capital. 5 to 10% over a period of time can move outside India, and that's really where I think our desire to set up a bit of a global platform comes in, because we already own the relationship with the client and he sees us as a trusted advisor. So there's no reason for us to lose that 5-10% wallet share also as he goes outside. Though we may not have the full-fledged platform to service him like a private bank, but definitely would want to use us as an advisor. And it's to ensure that we are able to continue to capture that 5 to 10% market share is really where you're seeing us also build out a global platform over the last couple of months. We've had a very experienced team, and hopefully by September of next year maximum, we would have a comprehensive advisory global platform set up.
The next piece on the transaction revenues, which have kind of...
Just speak a little louder, Ramesh.
Yeah, is this better?
No,
Yeah.
I'm saying transaction revenues on the wealth side have seen possibly one of the highest numbers in the past many quarters. Any thoughts there as to how should we look at it? Because in the past we mentioned that transaction is something that you wouldn't want to be a higher share of your part, so how should we think about this, say, from a medium-term perspective?
So I think, as I said earlier, I think that 450 crores is the number we are comfortable with. I think on a stress case basis, around about 350 crores. See, the not so exciting part of the transaction revenue is the fact that it's not, it doesn't have a mark-to-market element. Doesn't scale up in the same way as the ARR revenues scales up, right? So I think that's the portion of the, otherwise we like transaction revenue. There's no harm in it. The only problem is the scale up on transaction brokerage revenues is not equal to the ARR revenue, right? Because the ARR revenue kind of you don't have to start the treadmill again. It's already all set, and you also benefit from the mark-to-market increase in wallet share as well as expansion of the client's wealth itself. So I think I would be surprised if the numbers below 350, 400 at any point in time. And as our ARR revenues increase, the percentage of TBR will automatically come down. I don't think so. TBR is going to come down because we start booking lesser transaction revenue. It's going to come down as a percentage purely on account of the fact that our ARR revenues will keep increasing in a higher absolute form as compared to the TBR revenue.
And what would be the share of equity brokerage in your transaction revenues in this quarter?
Approximately 14 to 15 crores a quarter for us.
Okay, got it. Thank you so much and all the best.
Thank you.
So equity brokerage is a relatively small portion. It's around about 60 crores out of the 400 crores for the year.
Yeah.
So the NSE, parkings of something stocks like NSE and all would also be a part of it?
Yes, all that would be part of transaction revenue.
And how much would that have been in this year or a half year?
Would be around about 25 to 30 to 35 crores.
Okay, got that. Thank you so much.
Thank you. I think that's all we have time for. Thank you. And that brings us to the end of this conference. Thank you all for joining us, and look forward to hosting you next quarter. Wish you and your families a very happy Diwali in advance. Thank you.
Thank you. Happy Diwali, everybody. Thank you.
Thank you.